excellent CPI print, but it was good enough to send the markets into a roaring day to really cap off, or not cap off, but initiate a pretty good end of the week. So we're going to cover that. And I know many of you want to retire at 60. You want to retire at 60. You want to retire at 65. You want to retire maybe at 55. So we're going to talk about some of the income planning strategies, or at least some of the income planning techniques, some tax planning techniques to help navigate this market. And with me, as always, Chris Perras, our Chief Investment Officer here at Oak Harvest Financial Group. So, Chris, how you doing today?
Better than the last couple of weeks.
So when I first met Chris, and it was about 5 years ago?
Yeah.
Chris said, Troy, there's a reason why I don't have any hair. And it's because after managing money institutionally for 20 years, when markets go down, it's one of the most stressful times in my life because I care about what I'm doing. I'm passionate about this. I care about the clients. So I know you've had a very challenging year, just emotionally, because you care as much about what's going on in the portfolios as, I don't want to say as our clients because it's their nest egg, but darn near as much. So how refreshing was this week for you?
It's a relief. It was a relief rally. It's been a very stressful year. We had thought, there was going to be a correction this year. It turned into a bear market, which is, I guess, twice a correction. So it was nice to see some positive news this week on the inflation side. We put out a podcast on October 14th that was titled, what could go right? And we listed 3 or 4 things there. One was, we've been giving data about the CPI and real-time data. First, what the Fed is looking at. Well, the data came in on a couple days ago, weaker than expected on inflation, and the market took off in an almost historic way for a one-day rally yesterday.
It was historic.
Yeah.
Okay, so Aaron from Washington, how are you doing? Very thankful that you're here with us on the live stream. We have Bruce. Yes, Bruce, we are going. We were a little bit late there, but I blame that on Brennan over here. So, and then Kathy, you were here early. Thank you very much. So, please enter your questions. We're going to do our best to not only have commentary about the market, about retirement planning, but also answer your questions here. And if you guys don't submit questions, I do have some pre-submitted questions that I can always go through. So, we actually have our first one, and from Michael. Michael, how you doing? Will the market recover to the last peak? Please, with a question mark. Michael, let me. I assume you're getting close to retirement, or maybe just retired. So, and you're from Australia. So, that's we just got a new client from Australia. He's actually Australian citizen and United States citizen. But, Chris, will the market recover to its last peak? So S&P was at 43, 4,400?
The all-time high is 4,800 plus, at the beginning of January. For all intents and purposes, the market peaked last Thanksgiving. It was around 4,750. It exceeded that for a couple of days at the end of the year. I can come up with scenarios. If we're talking about the S&P as the market, I can come up with very easy scenarios where, we go back to those levels by the second half of next year. But what it takes is the Fed taking its foot off the accelerator of raising interest rates. It takes people exhaling, much as they did the last couple of days, and people being comfortable that the economy is going to grow at a very boring pace, maybe 1.5% to 2.5%, and inflation is going to come down at least to, say, 3.5% to 4% by the middle of the year, which, given the data we just got a couple of days ago, that's where the data that the government looks at, that's what the numbers would say inflation is by mid-next year, about 4%. That's not, my guarantees. That's just the math behind. If inflation starts to drop at the same pace, it's 4% by the middle of next year.
So Michael's actually a financial planner. So Michael, when Oak Harvest expands internationally, we will be in contact and see if we can open up an Australian office. That would be great. So
I'm coming.
So Chris, a couple things there. From the previous comment, we have been talking about the forward-looking inflation data for 8 months now, something around that time frame. And the Federal Reserve, when they look at data, they're looking kind of in the past, what happened last month. So we've been saying, if you guys have attended any of the last probably 2, maybe 3 live streams, that when we're looking forward, we're starting to see inflation stabilize. We're starting to see inflation actually come down in many areas. And we've been positioning to take advantage of what we were anticipating to happen, but the Fed was looking backwards. So how do you feel now that we finally got the CPI print that was what we were seeing way back 3, 4, 5 months ago? And also, what about December? Because we talked about this prior to the live stream.
So I feel better, but I'm nervous still because, listen, I didn't think we were going to print 8% inflation. This time last year, no way. If you'd have said we were going to print 8%, I would have said it's not possible. But the way they calculate things, I understand now how they're looking at things like rents, which is a very lagging indicator. The leading indicators have all fallen off a cliff, whether it's shipping container rates or used car pricing, a lot of these things. So right now, we're having this big rally. It's really interesting because the market basically bottomed in mid-June. We had a 2-month rally. It peaked almost to the day 2 months later in mid-August. We then sold off for almost exactly 2 months and bottomed, for all intents and purposes, on October 13th, 14th, which was exactly 2 months. So if you kind of look forward and say, hey, this pattern holds out, 2 months out is now mid-December. It's around December 13th, which kind of scares me because that's when the next CPI data comes out, and that's when the Fed meets again. So, I expect this rally to continue, not albeit at the same pace it did the last 2 days, through mid-December, and then I have no idea what's going to happen because you get into this time period at the end of the year. If that data comes in the last 2 weeks of the year and it's weak inflation, the market could be up 200 points in 2 weeks again. And we could close the year at 4,500. You saw, if you pull up, we just went up almost 200 points in the last 2 days. So there's a lot of negative sentiment in the market. And even with the last couple of days, there still is. But we need to see inflation slow down. And we got some bad news is good news earlier today. Consumer sentiment fell. It missed estimates by 6 percentage points. It's not under 50% yet, but it's down dramatically. So higher mortgage rates are hurting consumers' confidence. And you're seeing the headlines everywhere. Amazon's firing people. Disney's announcing layoffs. Facebook's announcing layoffs. So there's a lot of areas in the economy that are getting weak very quickly.
It's funny you mentioned bad news is good news because we just finished a 10, 12-year period where bad news was good news, but what it meant then was bad news meant that the Federal Reserve was going to continue to print money and lower interest rates. And now bad news is if we have poor economic reports, that means that, hey, inflation might be slowing down. The Fed may slow down the interest rate hikes. So in some vein, it's kind of similar, but also it is different in another way.
It's different in magnitude. I don't expect the Fed to all of a sudden start to cut rates, right? They had negative real interest rates for almost 10 years, and it made no sense that you were paying the government to basically hold your money. So now this is kind of an excuse for them to get interest rates back up so bonds actually yield a real return. Prior to this week, you could get a 2-year treasury for about 4.5%. Now I think it's closer to 4% just because of the big rally. But you want the economy and you want the markets to return to somewhat normal. And COVID in the last 2 years has been anything but normal with these big downs and then big ups. So, what I'd love over the next 3 to 5 years is a modulation in between. Boring would be beautiful right around now.
So this is kind of a good transition into the midterm elections because throughout the entire, through President Obama's entire term, the economy grew at around 1.5%, 2% average. Now, granted, the Federal Reserve was still printing money, was still lowering interest rates to provide some stimulus and a catalyst to economic growth or to primarily stock market growth. But that 1.5% to 2% growth is predictable for the stock market. It's stable as opposed to these bigger swings in economic growth, which creates bigger swings in your portfolio through the stock market. So if we do enter a period into more stable growth, which is probably the likely outcome in a higher interest rate environment, it's not necessarily bad for the market because it creates more certainty for investors, institutions, and those large participants, and most importantly for you who may be entering retirement at 55 or 60 or 65. Most of our clients, they simply want to protect their money. They just want to make sure that it's there for them so they can live off the interest, so they can have a plan to take income that if the market drops, their quality of life isn't sacrificed or their security isn't in jeopardy. So this is not, we don't need 4 or 5% GDP growth in order to achieve stability for stock market returns. So now we have a little bit of uncertainty removed. Not quite yet, because the election's unbelievably in the wealthiest and most powerful nation in the entire world. We cannot count votes very well. So,
in my home state's going to be the one everyone's waiting on, Georgia, and the Senate race down there, which will be determined on my birthday, December 6th.
Well, we're hoping for a good birthday present. So. Why? I'm not going to go down this path of why we can't count votes, and it's quite embarrassing, honestly. I'm sure many of you feel the same way. But now that the midterms are beyond us and we have that cloud at least removed, it does look like Republicans are favored to win the House. The Senate is going to come up to Georgia just like it did last time. And the one thing about Republicans winning the House is, if they do, is that the House controls the purse strings. It controls the spending. So one thing that is a benefit of that is the market knows in regards to inflation that there probably will not be massive spending bills. There probably won't be large pieces of legislation that could possibly exacerbate the inflation conditions that we're currently experiencing and have been experiencing. So how do you see that? Well, Chris, talk a little bit about historically. So this is absolutely astounding. If you haven't heard this stat yet, Chris is going to go through it. But talk a little bit about historically speaking, how the S&P 500, the broad market. By the way, if somebody knows how many stocks are in the S&P 500, if you could put that in the chat, I'm curious if anyone actually gets this right. Historically, after a midterm election, going back decades and decades, what should people know?
So we put a lot of this material in our podcasts and try to put it online in advance of what's going on. So we've discussed midterm elections, and the presidential cycle, it's pretty consistent, whether there's a president who's a Democrat or Republican. And it comes down to this, that the best period for the stock market tends to be from the fourth quarter of a president's second term, so that would have been October 1st of this year, through the first half of its third term, so that would be the first half of 2023. But you can go all the way out to the full third year, so all the way through what would be 2023. And in 16 out of 16 last midterms, the markets have been up. The S&P 500 has averaged from the fourth quarter through the second half, for the fourth quarter through the first half, the S&P's averaged 20%. The NASDAQ has averaged almost 29% positive returns. It's been pretty extraordinary. And it's not because, it's a Republican president or a Democratic president. It's almost always because the Federal Reserve is starting to ease monetary constraints, and Congress essentially neuters what the president wants to do. So very few things get done in Congress. They can't spend taxpayers' money unwisely. They can't raise taxes. And the stock markets, whether we as taxpayers like what they're doing or not, the stock markets like gridlock.
So the most important thing Chris just said was 16 out of 16. And we were going through a chart that one of our advisors, Chad, had sent. Chad's amazing. He very talented, works tremendously hard, but he sent me this piece, and Chris and I had been talking about it for a while, where going back to 1950, every single 12-month period after the the midterm election, when you look at the election day as a starting point, Since 1950, there's been 18 of those, and every single 12-month period after that, the S&P 500 was positive. So now that doesn't mean the market is 100% guaranteed to be up over the next 12 months, but that's a pretty strong historical fact when you start to look at the 12 months after an election or the year after the election, how frequent every time the market has been up.
Yeah, it's very similar to, we were having these conversations with clients and prospects into the presidential election in 2020, and there was a lot of back and forth between whether you're conservative or liberal. The stock market was going to tank or not tank, and history would show it almost doesn't matter. It really is up to the Federal Reserve and what they're doing with economic policy. And had Trump won in 2020, he would have had the Federal Reserve behind him. Biden won, he had the Federal Reserve behind him in 2021, and now Biden doesn't have the Federal Reserve behind him in 2022, and it's been a horrible year in the stock markets. So it's really up to what the Federal Reserve is doing, because people in the markets want to know, how much is it going to cost to borrow, or is the cost of running my business going up or down, and do I have visibility that I can invest shareholders' money and have a predictable, as much as it can be, return over the next 2 to 5 years, not 2 to 5 months.
So a lot of questions here. So there is a form in the description. If you can submit your question there, that will help us out. But I'm going to try to go through some of these here. So we have Bob. Has the Fed gone too far? So,
go ahead. I'm going to jump in here. So go listen to this week's podcasts, News or Noise, and the podcast we just put out today, because I have strong opinions of whether they've gone too far or not. I don't think they've gone too far, but if you listen to the podcast, what you'll see is exactly a year ago, in November of 2021, the committee behind Jerome Powell was out saying, hey, Jerome, inflation's a problem. We may have to raise rates really fast and higher than people think, earlier than people think. And Jerome Powell was out there saying, hey, don't worry about it. All I care about is employment. Fast forward to just this week, and behind the scenes, if you listen, and I'm sure the minutes are going to come out here in a couple of weeks, you'll hear the committee behind Jerome Powell is saying, hey, we've done a lot really fast. Let's slow down. Whoa, Jerome, we have, besides inflation, we have to worry about employment. And Jerome is out there saying, hey, it's all about inflation. So, my question in these podcasts is, who was right in 2021 for 2022, and who's going to be right for 2023? Is it Jerome Powell, or is it the committee behind him? And I think the committee behind him is going to be right, and they're saying, hey, slow down. Let's let these rate increases sink in.
Yeah, and even I saw some public voices this week where they're starting to come public, where espousing the same exact principle there. So, look, the Fed was late raising rates, so they're trying to play catch up now, and at the expense of your retirement portfolio. But we have to believe that they believe this is the absolute right thing to do to help inflation not get too far out of control. Now, totally different circumstances from the 70s. We're not at all worried about 17, 18, 19, 20% inflation. No. Who was it? Tudor Jones recently, the hyperinflation, the radio called me. I did the interview for the radio. No, it wasn't him.
Yeah.
But
Elliott Management.
Came out and said that hyperinflation is a possibility. So the radio station, they call me whenever they see some of these pieces, because they have to produce content and they have to put it out there, so they want commentary. And what I said during this interview was, look, a lot of these people, they say these hyperbolic or make these hyperbolic statements in order to really promote their own brand. And so, and also what it does, though, is it creates fear for you. It creates fear for your portfolio, fear for your retirement. But the truth of the matter is, we've seen for months now, looking out at the future data in volatility and futures markets and in the various places that we look, that inflation has been at least stabilizing, if not coming down. So hyperinflation is not a concern. But when we start to look at what the Fed has done, yes, they were too late when it comes to starting to raise interest rates. So now they're playing a little bit of catch up, and you and your retirement portfolio are the ones that are suffering. But here's where we're going to transition just for a brief moment. And so many questions. Again, if you have questions, I'm going to try to get to them as many as I can. But please, there's a form in the there's a form in the description box. If you can put them there, we'd appreciate that as well. So when it comes to, do you have enough? Can you retire? How much income should you take? How does this market downfall that we've went through this year, how does that impact your security? Those are all questions that can only be answered by having a retirement plan that looks at, we consider 5 basic factors. So the first one is the investment plan, and it's really about risk management. The second one is, where do we generate income from? How much income can we live off of? How do we increase that income over the course of retirement? And how do we also create multiple streams of income from various buckets? So that's what we call income planning. The last component to income planning is, from which accounts are we withdrawing that income? Your IRA, your non-qualified. There was a question that got pre-submitted about municipal bonds. Municipal bonds can be a bucket. They can be a part of an overall retirement income plan. Absolutely. So the third part there is the tax planning. So Chris, you don't get into much of the tax planning with us, with clients, but you hear the stories, you hear the planning whenever we're having these big meetings and we're getting together. It's not uncommon at all when we compare someone doing what we call the conventional wisdom style of retirement planning, where you defer those retirement accounts and take from your non-IRAs first. When we do the comparison of what many people, when I say many, it's most people, it's been the conventional wisdom advice in this country for decades and decades, compared to how we do it at Oak Harvest, where we're converting dollars into that Roth IRA. We're paying a little bit of taxes now to save from paying a lot of taxes later. A lot of times it's $300,000, $600,000, $800,000, $1 million in estimated taxes that could potentially be saved by going in this different direction against the grain. So those are the first 3 steps, but they all need to be working in conjunction with one another. Then, of course, we have the healthcare planning, the long-term care, and then step 5 of what we call the retirement success plan is the estate side of things. So I'm not going to go too deep into all of those, but everything that we're talking about tonight is the investment side. And why do we want to manage risk, and why do we want to talk about investments? Because they're a tool that helps to generate income. And then once we generate that income, do we want it to be tax advantaged? Do we want it to be tax free? Or do we just want it all coming out and paying income tax, which creates a domino effect for your Social Security and other streams of income, maybe real estate income, dividends, or interest? It's all one big domino once you get into retirement. So having a strategy to where all these moving pieces are working together is what we do at Oak Harvest Financial Group. That is the planning process, and that's what we call the retirement success plan. So Bob, thank you very much for the comment. Moving on to Philip from Chesapeake, Virginia, just saying hello. Philip, how are you? So John says, retired in the late 70s. All I hear is be patient. Have a 60-40 portfolio. I think you mean to say with time limited, what do you do? So John, do you know how long your money will last? Do you know how much income you're taking? What is your risk willingness, your willingness to stay committed to a plan? What is your goals? What are your goals in regards to legacy? Do you want to spend it all and bounce your last check? These are the types of conversations, and these are the types of questions that we dive into to help craft or customize that plan for you and your family. So if you have the income that you need and your risk bucket is this, now here's the problem. 60-40, so it's stock bonds, so it's 70. You've probably been told your entire life that stocks do this and bonds do this, or stocks do this and bonds do that. You're finding out that that's not necessarily true. So, and this is not, we've had actually, I think 3 out of the 4 past years where stocks and bonds have been positively correlated, where they move in the same direction. So there probably are other tools we can look at that are either non-correlated or protect against market risk and provide more safety of principal than bonds. So with your equity portfolio, depending on your income needs, the most likely thing for most people is we have to stay the course. Yeah. But when you're in bonds that drop 15, 20, 30%, that's difficult. And that's why we need multiple tools. We need multiple streams of income. And we want to get you into a position to where the whatever the market does, your security, your income, your life is not impacted. That's the goal. And that's why we call it the retirement success process is we don't want the market dictating how much income we have.
I want to give you some good news is, unfortunately, the 60-40 portfolio I think it's the worst return for a 60-40 portfolio in something like 100 years. It's off the charts if you look at distributions. The good news is that when you look at those outliers, the next year, which would be 2023, is usually much better performing. That doesn't do you any good this year. But the problem with the 60-40 portfolio is the Fed took interest rates to zero essentially, and the rest of the world did too for multiple years, and people were putting 40% of their portfolio in these investment income streams that yielded 0.5%, and now those rates have moved. Hopefully, whoever was managing that 40% was in short-term instruments, so those will reset over the next 6 months, 2 years, whatever it is. We own bonds, bond funds, bond ETFs for our clients. The allocation has been on the shorter term, but our clients have losses in those, just like everyone else. Warren Buffett has losses in his bond portfolios, even though he's holding cash and very short-term instruments. Everyone has the same problem this year.
But the difference between what we do and what the majority, I think, of just strictly investment managers do. So we look at bonds, short-term bonds, as a tool designed specifically for liquidity. Less risk, but they can still go down. But the 2-year short-term bonds, for example, minimally down this year, correct?
Yes. Yeah. And they will reset over the next 6 months, close, up to 2% to 2.5%, and eventually, right now they get to 4% by probably mid next year. Whereas at the beginning of the year they were 0.5%, something like that. Yeah.
So, but beyond just the short-term bonds, when you look at protecting the principal, with interest rates rising right now, the fixed indexed annuity is a tremendous asset class to protect your principal. I mean, right now, the most simple, clean fixed indexed annuity out there, it's a 7-year product where your worst case scenario is 0. Your upside is 10.75. So you're going to make between 0 and 10.75. But the coolest part is that your gains lock in. So if the market makes 20, you make 10.75. If the market makes or goes up 8, you make 8. If it goes up 10, you make 10. 0 to 10.75. But the cool part is that gain locks in. You can never lose that gain. So the next year, if the market goes down, your principal and your interest is protected. The following year, if the market rebounds, well, again, you're going to compound on top of that previous balance from a 0 to 10.75. So it's a tool that provides safety of principal. There's no annual fees. There are surrender charges, so you want to make sure you don't put too much money into those types of tools. And I know the word annuity is a bad word for many of you, but today's strategies are so much different from what you've become accustomed to. If you pass away, all the money plus interest goes to your family. If you need to access it while you're in retirement, you can take out up to 10%. So you don't want to put too much money into these tools, but if you want safety of principal and you want the potential for upside growth and you want to sleep at night because you're concerned about the market, you don't want all your money in the market, and your bonds have gone down this year, so you actually want to add an asset class that has safety of principal as a primary component of it, it can be a very valuable tool inside a comprehensive asset allocation. So thinking about some of those tools and combining it all together, then how do we generate income? The cool thing about the fixed indexed annuity, when used appropriately, is with that 10% withdrawal feature. Let's say we have 300,000 over here, 700,000 in stocks. We're living off the dividends and interest, so we're not touching principal if we're in the retirement income phase. But if the market goes down, we can go into that account over here, the 100% safe account, and take out $30,000 or $15,000 or $20,000 to supplement your Social Security. It's just one example, but we can tie all those different pieces together to create an income strategy to where when we do the analysis, for many, many people, it creates more security. It creates a lot of times less stress, but also it can create more income when you look at some of the features and benefits. So, so that is something to possibly consider and learn more about. Okay, so moving down here, Lisa. So Lisa, not making up the losses and having any additional downsides before we pull the trigger on retiring. So Lisa, I think you're saying a concern is not making up the losses, and you could possibly have some additional down slides in your portfolio. Yeah, that is a concern. But again, the answer from me, at least, because I'm a planner at heart, this is what I love to do, and in our entire company, this is who we are. You need a plan. So the most simple plan could be having 1, 2, 3 years of very low risk liquid money available to you to get you through that potential downturn in the market. Now, does that leave you enough equity exposure to accomplish your long-term goals? So the market's been down 3 consecutive years, only 3 times in American history. The Great Depression, World War II, and the dot-com bubble, 2000, 01, and 02. It doesn't mean we can't be down 4 consecutive years, but that is the historical record. We've never been down more than 3 consecutive years in the market. So one thing I will tell you, Lisa, is please do not allow your emotions to dictate your decisions.
And from an investment perspective, and no one wants to hear this, but you are not worth what you saw in your statement on January 3rd, right? The day you opened up your statement and you said, you know, the absolute tip top of the market, which was, I think, January 3rd, I'm worth, you know, $500,000 or, you know, $1 million or $5 million. You are not, because there's no one in this world who's going to liquidate your entire bond portfolio and stock portfolio at that point in time. And even if they did, you're going to be paying taxes on all of it if it's in a taxable account. So you have to get out of that mindset that I have to get back to that exact level, because if you get in that mindset, you're never going to make the right decision for the rest of your life of, okay, I have enough. You know, is it 5%? Maybe it's 5% less than that number. I don't care, right? I don't need the stress. I can meet with an advisor. They can plan it out for me. I'm going to have the cash I need. You know, if I want to leave it to my kids or a charity, that money's going to be there. I'm done. But don't get that figure in your brain that January 3rd, I got to get back to that number, because you'll be paralyzed.
Yeah, because it really is a fake number. It's a
fake number.
That's an excellent point. So just because, and what Chris is saying, he's referring to the highest point that your portfolio reached, and just saying January 3rd, because that was the market high?
I think
roughly?
It was, yeah.
So it's easy to do, though. I mean, when you open, especially those of you who are watching the accounts every single day and you're logging in, and it's fun to do when the markets are going up, and especially those of you who are maybe overly concentrated and not properly diversified. You could have really seen some explosive growth, but that's an excellent point that that's not real growth. That's not your real value, because when you hit that point, you were really in an episode of I don't want to call it greed, but I mean, ultimately it's you know, getting aggressive, seeing the market go up. For those that maybe were overly concentrated in Amazon and Apple, for example, taking excessive risk. But a lot of normal people, just with normal portfolios, they also saw their portfolios hit that all-time high. And then we see that number and we think, well, that's what I'm worth. That's what I need to get back to. But that's an emotional trap. So Chris, any...
We all do it. I mean, I look at my accounts and go, hey, you know, it's down XYZ. But you have to get out of that mindset, because even if you were to find someone who could sell everything at the exact top, bonds and stocks together, because most people own both, then you have to pay taxes on it all if it's in a taxable account. So, you know, the money that you saw in your brokerage account, it's not, you know, that number that was the max, your high water mark or whatever, it's not real. So that's where I think sitting down with a planner, sitting down with a team who can work the numbers, and, you know, the stock market is about average returns over long periods of time. It's about compounding over 5 years, 10 years, 15 years. And yes, you know, the dot-com bubble felt great on the way up. Last year felt great on the way up. It feels miserable on this side. But it, you know, stocks are average returns over longer periods of time.
You know, one question, so it's called the Dan Sullivan question. So I don't know if any of you know who Dan Sullivan is, but an amazing human being. And he has a question to where he says, if you, I'm probably going to butcher this because I haven't said it in a long time or read it in a long time, but basically, if you were looking back at yourself 3 years from now, what will have had to have happened for you to feel happy, satisfied, accomplished, fulfilled? So it's definitely much more succinctly stated by him, but it's a question that really invokes tremendous thought, and it makes you put yourself into the future while looking back. So if you are feeling like, I'm about to retire, oh my goodness, what's going to happen? Or my portfolio is down, what do I do? Put yourself into the future 3 years from now and kind of look back at yourself today and say, what should I have done? What could I have done? Because the only thing we ever ask clients to believe is that capital markets work. So when you get caught up in the day-to-day fluctuations, the volatility of the market, it starts to create emotional havoc, and that emotional havoc leads to bad decisions, bad actions. And if you can, if at all possible, put yourself 3 years into the future and then kind of look back and say, you know what, this is where I am now. What could I have maybe done differently, or how could I have been better off? I think that might be a good way to kind of deal with, especially those of you that are entering retirement, because it is a very stressful time. But I can't say this enough. You have to have a plan. So I wanted to mention this. So Big Sean here, how you doing, Big Sean? He says, why do financial advisors recommend participating in a 401k up to the match and then start contributing to an IRA and then go back to the 401k once you've hit your IRA limit? So Sean, I think I can say this, that's bad advice. The only reason I can think an advisor would tell you that is because they're going to make money when you put it into the IRA, I would assume. So it's speculation that it may not be the case, but really there's no reason whatsoever to stop contributing to a 401k once you hit your match and then start to put into an IRA and then go back to the 401k once you've hit that. Now, I guess, so the early access rules are slightly different when it comes to 401k versus IRA, but they're both pre-59.5, 10% penalties. You could convert, so here's a kind of a workaround. You could convert the IRA to a Roth, okay, and then once you convert that IRA to the Roth, if you wait 5 years, you can then pull out the contributions or the conversion amount without that 10% penalty. So it's kind of a backdoor way to get around that 10% rule. But I have a feeling that that's probably not the case. So there are, I guess there could be advantages to that, but it's nothing I've ever heard a financial advisor recommend. The most important thing we want younger people doing that are working is contributing as much as you can. And if anything, maybe save outside of the 401k and IRA so you actually have non-qualified money, non-retirement account money. So if an emergency comes up, if you have something you need to pay for, you have your qualified dollars and you have your non-IRA dollars. The non-IRA dollars are not subject to that 10% pre-59.5 penalty, so you have more flexibility. And our pre-retirees and even soon-to-be retirees, we're constantly trying to get them to get money outside of the retirement account because your 401k, your IRA, it is a tax-infested nightmare. If you've seen any of the videos on YouTube where I talk about tax planning and income planning and long-term strategies to having income coming from multiple different places, we need money in outside sources, outside accounts, in order to either pay tax on Roth conversions or to supplement our retirement, where maybe we'll pull $40,000 from the IRA and maybe $40,000 from the non-IRA. That way we can manage the income that goes on our 1040, which is the tax return, so we can control how much tax we're paying. Retirement is the only time you actually get to control how much tax you pay. But if you have all that money inside the retirement account, you have no choice except to pay income taxes on 100% of it because you weren't prepared from a tax perspective. So I saw that. I wanted to touch on it. So hope that helps.
Got nothing. Not my area.
Okay, Fast Eddie, you comment on a lot of our videos. Thank you very much, the YouTube videos that I put up. Fast Eddie, you're 59, your wife is 57. Your Social Security at 67 will be $1,889. Your wife's at 67 will be $3,100. We would like to collect hers at 70. When would you have me start taking mine? So now, Fast Eddie, you've watched enough of my videos where you know my answer is going to be, I need to know more about your situation. I need to understand the assets, the tax situation, the health, because the highest Social Security, or excuse me, the healthiest spouse usually will inherit the surviving spouses, or excuse me, the spouse that passes away, their Social Security. So here's the thing about Social Security. It should never be made, the decision when to take it should never be made in a vacuum. It should never be made in isolation. It should be decided with respect to your assets, your income, your health, so many different factors. So that's the biggest takeaway there. Make sure you make that decision with respect to an entire plan, because many people don't know this, Chris. I don't think you've ever even heard me say this, but did you know Social Security for most people can be well over $1 million of retirement income?
No.
So if let's say two spouses have combined $50,000 of retirement income. So one spouse maybe 35, the other one 15. So get us to 50,000. So over 10 years, that's 500,000. Over 20 years, that's $1 million. Over 30 years in retirement, it's $1.5 million. And many of you have Social Securities that are higher than that. So Eddie, yours, I think I saw 1889 and then 3100. So let's call that 5100. So that's 60,000 a year. So that's 1.8 million in a 30-year retirement coming from Social Security, and that's nominal. That's not inflation adjusted. You have to compound an additional 3% annual estimated inflation increase there. So yeah, it can be well over $1 million, up to $2 million of retirement income. But Social Security has tremendous tax advantages if you've planned your other assets properly. So we put a plan together recently for a family where they've been working with us for some time. And just to keep it kind of generic here, the overall goal, because pretty simple people, they wanted to live on about $70,000 to $80,000 of income. They had some money in a retirement account. So for the past 5 years, we've been converting their IRA into a Roth IRA. So we've kind of eliminated the required minimum distributions. Now all of the Roth IRA income during retirement is 100% tax-free. But what that also does is their combined Social Securities are also 100% tax-free. Now that's cool. So they have both their Social Securities plus their retirement account distributions. Their income goals are being met. They're loving life, and they're not paying a single dollar in taxes. So hopefully that's a good example to communicate why you don't make that Social Security decision in a vacuum. You make it with respect to everything else that you're doing. Okay, going to transition back to the midterms because I put an advertisement out or a video prior to this. We talked about, or for the promotional side of this YouTube live stream, where we're going to talk about how the midterms impact your retirement. And I know many of you have questions, and I want to tie the inflation print back into it for some of you that are joining a little bit late. So, okay, we had the good inflation print. Just a quick recap. How do you see inflation playing out in the first half of next year?
So, if you've watched the videos, I'm not a big fan of government data just because it lags, but I've looked at the government data. People who are much smarter than me have kind of dissected it. And I guess when the data came out yesterday or 2 days ago, the inflation data was, I think it was 0.4 or 0.5% month over month. If you extrapolate that for the next 6 months, that drops inflation by mid-year of next year to around 4%. So I personally don't expect inflation to get back to 2% anytime soon, which is the Fed's goal. And I haven't thought it was going to get to 2% for 5 years. I thought before this inflation picked up that we would have inflation of 2.5% to 3% for probably the next decade to 2 decades, largely because baby boomers are retiring and dying and moving out of the workforce. Millennials and Gen Z are such a big demographic that they are likely to demand and consume magnitudes more of goods and services than the baby boomers who are leaving the workforce and leaving us are consuming. So it's kind of the same dynamic, just in a bigger scale of what happened in the late 70s, early 80s, as the baby boom was kind of moving through their consumption years.
Okay, so we had a lot of responses to the, thank you, Chris, had a lot of responses to the S&P 500 question. So I believe the answer is 505. Now, it's possible someone could have got kicked out or maybe put back in, but 505?
Well, last time I looked, it was 505, and it's because there's different shares of classes So Google is counted twice, I think.
So Rita, you got it right, but your first answer was 500. So I kind of have the feeling that you Googled it and then put in 505. So, but so many people said 500, and you would think it's the S&P 500, but no, there's 505 as of last count. So somebody Google that, and if I'm wrong, please let me know here, but should be 505. Yeah. And then we put a poll out there. Have you signed up for our free report? 72% of you said no. So come on, some of you can sign up for the free report. It's actually not bad at all.
Can I answer that one?
Okay, so Q&A. What are you most worried about in the? Oh, is this from us? This was us.
Don't know. Oh, that's us.
Yeah, so this is us actually asking the question to the audience. What are you most worried about? It's actually a really good question, so I'm going to turn that on you.
Yeah. The question here is, what do I worry about most in the markets? It's a big picture question. We have $31 trillion of additional debt that our government has taken on the past 30 years. And it's not just a President Biden thing. It's a President Trump thing. It's a President Obama thing. It's a President Bush thing. We had about $1 trillion in additional debt when President Bush started. We now have a 31 trillion of extra. Interest rates have gone from essentially 0 to 4 or 5%. It is $1 trillion in annual interest that we're responsible for. And what does that do to our economy? What does that do to our government, to our spending, to our children? That's what I worry about, and I don't have the answer. I don't like debt. I would have not taken out 30 trillion in debt the last 30 years. I'm one for, pay your bills as you spend the money.
Houston, I texted you on election night because I went and voted late. The city passed. It was pretty big majority, I think, too. $1.7 billion in bonds. Yeah. I don't know. I mean, we don't have 1.7 billion to ever pay back. That money will never be paid back. I don't get it.
The only way to do it is increase taxes or to depreciate the dollar, which the doomsday scenarios that we get a lot of people watching TV, and I've heard for the last 10 years about the Great Reset. They're going to confiscate our 401ks. They're going to confiscate the dollar. They're not going to confiscate those things. We already have a digital dollar. My children, your grandchildren, your kids, I almost guarantee you they do not carry cash, right? It's credit cards, it's credit, debit. That is a digital dollar. They don't have cash. But it concerns me that we have so much debt, and we're going to have to raise taxes at some point in time if we want to pay that debt down.
We'll never pay it down.
And we won't pay that amount down, but if we just want to keep it, even at 31 trillion or whatever the number is.
And to not be doomsday here, so for many of you probably aren't aware of this, most of that debt we owe to ourselves. So you ask, how can that be? Not going to go down that road, but we owe it to ourselves. The Fed prints it, the Treasury spends it, the cycle goes on and on and on and on, and apparently it inflates economies and markets, and then we go through what we're going through now. So
it's the reason a Big Mac cost, I think it was 50 cents in 1980, and now it's $5, right? There's more dollars out there circulating, and we haven't increased capacity that much, so the prices go up.
So Tom, one of my favorite jokes there. So Tom said, help our 201k. So we used to say back in 2008, we used to make that, it's not a joke, but clients would come in and they're like, Troy, my 401k got cut in half. And then we'd say, okay, so now it's a 201k. So that kind of brought me back there, Tom. So yeah, Tom, give us a call. We'll see what we can do to help you out here. There's a form down below. You can reach out to us.
And a lot of these questions that come to the markets, they're interesting. The S&P is down. I have to look. I think it's down maybe 16% now, and the NASDAQ is down close to 30. The NASDAQ minus 35% is about as low as it's gone historically, except for the dot-com bubble, except for the great financial crisis. So tech stocks actually probably look interesting here. But your investment manager should have a diversified portfolio for you, right? He should have some staple stocks. We own boring stocks like Coke and Pepsi and McDonald's in a lot of portfolios. And we were buying them 2 years ago when tech stocks were going straight up, and people were like, why do we own those boring stocks? And now you know why you own them, is because we don't try to create portfolios where everything's going up at once. Because if you own that portfolio, as we found in the dot-com bubble bursting, or the energy bubble bursting in 2008, or real estate bursting, if you own that portfolio, it feels great on the way up, but I don't know anyone who's going to get you out of 100% energy, 100% real estate, 100% technology and it paralyzes you. So we try to diversify portfolios.
Yeah, I mean, the main thing is to stay balanced, stay diversified, believe that capital markets work. The question we have to deal with a lot is, Troy, are you guys going to get out of the market? It's down 25%. Well, no, the time to get out of the market, if you're going to do that, would have been back in December when everyone was feeling good and things were going great. But no, you can't get out of the market when it's down, because you guys know the rest of the story there. So staying diversified, having a balanced plan, and having, when I say plan, it's having the right amount of money exposed to tools we call stocks that have tremendous upside potential, but also have extremely volatile downside potential. So once you get into retirement, if you get too exposed to that side, of course, then you start to get into a situation where you make emotional decisions. And that is the one thing that can absolutely destroy a retirement, is making emotional decisions because you were too overly exposed to equities according to your what we call risk willingness. So I just went Straight Jacket Studios over here. We were talking about the midterm election. I want to point this out because it's a great point. He says it's proof that investor confidence relaxes after every election when the world actually doesn't immediately end based on election results. And you couldn't have hit that more spot on, because the media's job is to scare you. The media's job is to make you afraid, because the more afraid you are and the more scared, that means you're going to tune in the next day. The more eyeballs they get watching their show, the higher they get in terms of dollars for their ad revenue. So it's a simple mathematical game. The more, with financial shows, the more greedy you are, or the more fearful you are, the more money they make. So please just keep that in mind. You can tune in any TV show, any website, and see that it's super positive, it's super negative, and the brain can't handle that, honestly. The brain starts to spaz out, and it's like, what do I do? When really, have a plan. Stay connected to that plan. Have somebody that you trust, that you're working with, that you can call up and say, hey, I read this, I saw this, am I okay? Hey, let's pull up the plan. Let's look to see where you are, how much income you're spending. This is what we're doing with taxes. This is why we think you're going to be okay.
This is a digression really quick, if I can. It's amazing. So I love technology. My background was electrical engineering before I get into finance. And, it's improved our economy and our world, 100,000 times, a million times, whatever, for the most part. However, when you start to think about, I'm 56, I grew up with 3 or 4 TV channels, 3 main ones and PBS. Those TV channels gave you the news. There was no entertainment. It was true news, right? They were telling you news. When I was a teenager, all of a sudden they became cable, and there's 100 channels. Okay. And now it's not just news, it's entertainment. My kids, who are now 21 to 25, they grew up with essentially infinite channels, right? Twitter, Facebook, Instagram. Everyone and everything is their own channel. So it's no longer news on Fox, ABC, CBS, or whatever. It's 99% opinion and entertainment and 1% news, because they're competing against fewer and fewer people who are watching TV, and more people who are watching live stream and Instagram or TikTok or whatever it is. So they're trying to just catch your attention by way of emotion and keep you engaged, so they can actually make their money by selling advertising. And that's not by providing you news, it's providing you opinion and entertainment.
So Rita and Norm, 2 questions about mortgages and real estate entering into retirement. So Norm kind of hits this where I tend to answer the question. So In retirement, one of the things I've learned over the years from working with thousands and thousands of people is that there's the mathematical right answer, but then there's the one that makes you sleep better at night. So essentially, Rita says, should you plan to pay off your mortgage before you retire if it's your only debt? So if you've owned that home for a long time and you're not speculating in real estate and you are potentially underwater, most people, a mortgage is what we would call good debt. It's not credit card. It's not a depreciating asset like a car. It's good debt. And once you hit 65, although I'm not recommending a reverse mortgage, if you have 50% equity, you always have that in your back pocket where you can completely get rid of your mortgage payment. Now, again, kind of off on a little tangent there, but the mortgage itself is not necessarily bad debt. The question becomes, do you have the other assets and income to comfortably support yourself in retirement so you can continue your standard of living? If not, then maybe we do need to make plans to pay that off. Are you a risk-averse investor to where the funds that you have to pay off that mortgage, if otherwise deployed, would not be earning a higher rate of return than the interest rate on your mortgage? So Norm kind of brings that up. He says, for most, math says keep your mortgage and invest the difference or invest the funds. And he says, unless satisfaction of not having a mortgage is worth that much. And I think what you're saying basically, Norm, is the emotional side of things. Hey, if you feel better and it helps you sleep more at night, then yeah, go ahead and pay that mortgage off. I tell clients that all the time, even though what a lot of times what happens is the husband will say, yeah, let's get that money invested. But then I look over and I ask his wife, his wife, and I can see that she would sleep better at night if that mortgage was paid off. So my advice typically then is, hey, go ahead and pay that mortgage off because this is just money. Money in retirement is nothing more than a resource that you can use to provide security and comfort and to enjoy the things that you deserve at this stage. If it makes you feel better and you sleep better at night, damn the math, go ahead and pay it off. But if you're an investor and you want to invest that money and you believe capital markets work long-term and you sleep fine regardless, yes, please go ahead and invest that money. It's a personal decision. It should be made with respect to your entire plan. Okay, Dan says, if you have a substantial pension, do you need other accounts outside your 401k? Now, Dan, this isn't, it's one of those gray areas. I'm going to say yes, because one of the problems when we're planning with someone that has a pension, and this depends if it's a military pension or if it's a pension from a school district, for example. So certain people who receive pensions never paid into the Social Security system, so therefore they don't have a Social Security check. Other people who have pensions do also have a Social Security check. And either way, when you start to think about the tax planning when it comes to your pension and possibly Social Security, and then if your other assets are only in a 401k, well, the pension's 100% subject to income tax. There's nothing you can do about that. Pensions are great. We love pensions. But from a tax planning standpoint, we're 100% limited. There's nothing that we can do. Now, the Social Security, it has tax advantages if the other assets are properly structured. The 401k, everything that comes out of there is going to be 100% taxable. So when you start to look at, should you have other assets? Yes, because we can strategically take from various places to manage what goes on your tax return. And that's income and tax planning. That's step 2 and 3 of our retirement success plan. And when you look at and you extrapolate out over many years, for many of you, it can save tens of thousands, hundreds of thousands of dollars in taxes. So yes, you're welcome, Fast Eddie. Opportunity zones. So yeah, sure. You want to take this one?
So there's a question here on our view on opportunity zones. And so we've looked into these investment tools multiple times over the last 3 or 4 years. And due to the length of time that's required to actually keep your money in them, which I think is 10 years, for the most part, for a lot of these instruments, aren't they?
I'm not 100%.
We've yet to be able to find many clients who are willing to lock their money up for 10 years. They're great in theory. I mean, I've read about them multiple times, and they sound great, but when it comes to locking your money up for 10 years, we don't have a lot of clients who are saying, hey, yeah, I want to do that.
So someone says Straightjacket came back and said it's actually 503, not 505. So maybe we lost a couple companies in the S&P 500. Maybe,
just some
as
share
Twitter
classes.
fell out, right? Went private.
I think it's usually share classes that change things up. So yeah.
Okay. So worried about how nope, that's us. Shout out to Nicole. Yes, she is amazing. So someone asked earlier, how do we decide which client goes with which advisor? So we have every client here works with multiple advisors. So we have what we call a pod structure internally. So you have your lead advisor, you have the planning advisor, and then you also have another advisor that helps with the planning as well, essentially. So, and the reason we do that is because we want continuity with the client experience, but also multiple people that are familiar with your family, with your needs, with your situation, and then they're brainstorming together. That creates just a better synergy of a working relationship. But also we have the CPA here, so we have a tax team, and working together with the advisors with respect to your taxes, your situation. So we just simply don't believe in a one person, one relationship type firm. We have a pod structure where we multiple people work with you. So why is the news for profit? Never was before. That's
that gets
it.
back to its
Yeah, that's an excellent question.
entertainment.
So, okay, I think we've kind of went through the questions here. Any we're at 7:00 Central Time here. Chris, any last bits of wisdom or tidbits of knowledge?
No, it was a great week in the markets and a great week in Houston because the Astros won the World Series.
Yep.
So we were all celebrating that earlier in the week.
What about?
I would expect people keep asking about volatility. Volatility, started to come down. That's one of the reasons the market is up. The thing that's driven volatility all year it's not been stock market driving the volatility. It's been the bond market. And if you look, interest rates are just moving around so fast because what the Fed is doing. If the Fed starts, they can keep increasing interest rates so long as they do it slowly and methodically. If volatility starts to come down in interest rates, it's going to come down in the stock market. That's a good thing for investing.
Bruce, go Ryan and Liz. Yes, rock stars. They are amazing. That's an interesting thing you said there. The bond market has been driving volatility.
Oh, yeah.
So, you look at 20, 30-year bonds down 20, 25, 30% this year. Some people are having a rude awakening when it comes to what they thought were safe investments that have, tremendous volatility in the interim before they mature.
Yeah, we've done a couple podcasts on this. And so government treasury bonds beyond 10, 20, 30 years, their returns are as bad, if not worse, than a lot of stocks in the market. And we've done podcasts, and I've called it collateral damage. And it's because these treasury bonds are used by all these investment managers all over the world as collateral to buy other things. They go out and they buy real estate, and they go out and they buy stocks, and they buy oil properties. And a lot of times they don't have hard assets. They just have these treasury securities, and they put them up as collateral. And once that collateral starts moving around really fast, it makes everything move around fast.
Yeah. And someone asked earlier about laddering T-bills, treasuries over multiple periods. I haven't looked at personally in a little bit 3, 5, 7 years, but I can't imagine they're much higher rates than what the 1-year T-bill's paying right now.
No, they're all paying close to the same.
Yeah.
Just the whole curve is moved up. I think the 10-year treasury is now 3.85, and the 2-year might be 4.5. So you get a little more for just giving the government your money short term, and that's all due to the uncertainty about what the economy is going to do in 2013 and 2014.
23 and 24?
Yeah, I'm sorry.
All right, that is our cue to wrap this up. Chris just went back in time.
Back in time.
We have a form in the description box. Watch the YouTube channel. Obviously, we have a lot of great videos out there. Reach out to us if you think we can help you. If you're a client or a prospective client watching this, thank you very, very much. We do appreciate you, and we look forward to seeing you next month on our live stream. So have a good weekend.